checking to see if we have audio. I'll go to chat and see if you can hear me. Max, sound on? Great. Okay. Well, good morning. We will be hosting this webinar in English just because I know that a lot of the venture scene involves international folks, luckily so, and many will be puzzled. So we will stick to the so-called kings and see how we fare. I'll give the last few people a few minutes to log on. Thank you for taking the time. I hope this will be informative. If you have any questions, put them in chat and we'll get to it. Let me see how far along we are, by the way. Yeah, this looks like we're up to a good batch. Okay, let's get started. So you may have seen the memified stuff that's going on in the Netherlands. A 36% tax on unrealized gains does not sound good. A matter of fact, I don't think it is super good. Look at some of the international response that has been going on. Wealth confiscation is here. I just want the kindertoeslag on the 5 unrealized kids I have. I think that's a good one. AOW on the 40 years of unrealized work. But yeah, many of you may have seen this meme that Michael Jackson here is posting. And yeah, all in all, I guess international reception is less than enthusiastic. So much so even that some folks are getting asked maybe you should move abroad if you're the owner of a startup company or an investor in one. Um, so yeah, if you take your news from X threads, Reddit, you may be panicking. So that's why I was thinking, it is a work in progress still. It's time maybe to take a little bit of a step back and put this into context. First of all, I want to talk about what even this box 3 thing is that we speak of, and also I want to discuss fact and fiction, and let's see what's sensationalist and what's real. So here we go. I'm taking 45 minutes, so I'll be quick. But if you have any questions, like I said, let us know. All right. First of all, what even are we talking about? The thing we are talking about is box 3. And let me get a little taxi and maybe boring, but this is about the Dutch Personal Income Tax Act, which means we're talking about Dutch residents and persons with income from Dutch sources. But mainly, you should know that box 3, the Dutch systematic, as we call it, for savings, income from savings and investments, it applies to people living or that are resident of the Netherlands first and foremost. So that's an important thing. Yeah. So Oscar Petit, yes, we're talking about global income, but this is for if you are not a Dutch person. The Dutch Income Tax Act can apply to you if you have income from Dutch source. That's how we make sure that, for instance, a American who rents out a apartment in Amsterdam will still pay tax in the Netherlands according to our framework for it. But let's look at these boxes, what this is. If you're a Dutch taxpayer, this may sound very familiar to you, but this is just a mind map. So if we talk about the boxes, the Netherlands runs a so-called analytical tax code, which means it matters what the source is of your income, how we tax it. This opposed to a synthetic income tax code where we put everything in one heap and then apply a certain rate to it. We have different rates for different elements of income. So this is how our 3 boxes work. And I always like to consider them, like a box that can be on your desk. And at the end of the year, there are some labels that ask you to put your receipts of the year in certain ones of these boxes. So that's how we can mind map it. Box 1 is where your income from your business and the job goes. So this can be a proprietorship, this can be wage, and we've also put your home in it so that you can offset mortgage interest against your wage. Basically, this is a pay-as-you-earn regime, 37 to 49.5%. I know that in itself is surprising to many, but we're used to it. Box 2 is where we have closely held shares. So that's 5% or greater stakes in companies. And that's where you pay actually a capital gains tax, 24.5 to 31% tax, pay as you earn. And then we have this weird thing, which is called box three. And that's where we place your income from savings and investments. And that's where we tax you for redeemed income currently at a rate of 36%. And you may be wondering, how so? What's the rationale there? So really, it's this. Look, what's in box three? It's a lot of stuff that may not be really may not have a lot of administration going on. So a big chunk of the wealth that's covered in box three consists of checking and saving accounts and maybe stock portfolios, listed stock portfolios. You may be, trading yourself, but also it covers second homes or rented out real estate, government bonds, even art collections or an old timer car, a watch that you wouldn't wear on a daily basis, assets basically. Yes, Brian. And but also small business investments. So a loan to your neighbor, his company, their company may qualify, but also startup and venture capital investments, and maybe even employee incentives. So you may be part of a ESOP, employee stock ownership program in your employer, and this stake would also fall in the box three bucket. And to understand why at one point we agreed on a deemed box three basis, we need to go back to the year 2001, because that's when this income tax code was introduced. And I looked up what the biggest song of the year was, at least in the Netherlands, and it was Safri Duo. I think everyone remembers it. I also look at Sander specifically, music lover here, but that was just to put this into perspective. That's the year that 2001 was. And there was this one man, he was our Minister of Finance, and his name was Gerrit Zalm, or Jerry the Salmon. Um, and he came up with this system that we came to accept. What was the idea? We think that if you have closely held stock, so at least 5%, we can tax you on a pay as you earn basis because you can share a single entity with at most 19 other persons. So you should have fairly accurate access to information. Uh, One of the key examples here being a personal holding company. You should be able to tell exactly how much dividends or capital gains you make from your personal holding entity, because it publishes annual accounts and you are the sole owner, so you should be up to speed. When it comes to box three, and we look at, for instance, investments in your neighbor kid's company, or I don't know, a watch collection, or some bonds that are off market in Chile, it gets a lot more difficult. So in order to arrive at a so-called workable situation, we say, all right, we just look at the January 1st fair market value of all your box three assets. We deduct from that amount the sum of the related box three debts, and we take off a 50K exemption. So everyone gets to own 50K of net assets. And we multiply that balance by a 4% deemed return and tax that at 30% tax. So that really added up to a 1.2% net asset tax. And yeah, this had some winners and some losers. And when this was introduced, already Dutch people were pretty defensive with their assets. So Jerry the Salmon was asked, is that not a bit much, 4% return? And he said, and these are famous words actually, these have come back to haunt him because I think he was in a funny mood there. But he said, every schmuck makes more than 4% return. And if you cannot manage that, you can come to me and I will get you government bonds yielding 6%. Which at the time was a very feasible setup because indeed government bonds had a 6% return. But oh, how the times changed. First, let's look at what this meant. Regardless of your actual return, you would be taxed for a 4% deemed return on your asset balance, which means if you got a much higher return, you would be taxed at a much lower effective rate, because you can imagine if you're taxed for a 4% deemed rate at 30% and you're making an 8% actual return, you're effectively taxed at 15% because the tax is a lump sum. And accordingly, if you perform much worse, your effective tax rate rises. This was accepted because the system had some winners, had some losers. And also it was seen as a motivation to kind of, keep the money rolling, do some investing, and not just leave it sitting idle in the bank, because, in GDP calculations, everyone knows that mobility of capital is an important element in growing GDP. So for a long time, this was largely accepted, and everyone kind of knew that there was an unfair zone that was conceivable, but with a 6% return rate on very low risk government bonds, that was so avoidable that, yeah, uh, the unfair zone never really got into the picture. I think we all kind of agree that this has two unfair outcomes, right? People can be overtaxed, people can be undertaxed. And with this also came a lot of, if you look at the Dutch income tax code of 2001 now, it must have become about two, or no, I think four times as long. And that's because people started to mess around with it. So if you're a private equity manager, you would want your carried interest to be a box three asset, because if it performs really high, you'll have a really low tax rate. And that's how we got the lucrative interest legislation, where we look at, carried interest loopholes, where we look at, is this a real return on equity, or is this a bonus dipped into equity income? And, it just started to get a lot more complicated from there on out. But at the same time, world events took place as well. We had the financial crisis of 2008. We had COVID, which I myself do believe was a thing. And most importantly, this led to quantitative easing. And Jeroen, I do agree, the tie on the left, it's not a good choice, but this is American fashion in the early zeros, I think, and to each their own. But what happened here is that we started really quantitative easing, and that meant that interest rates really dropped, uh, while equity rates rose, as is, what kind of always happens. And with the Dutch, defensive DNA in investing, the unfair zone got into the picture after all. Because, well, a lot of people that were investing mostly, they had very high tax rates. Because look at this. This is the 10-year historic Dutch interest rate on government bonds. And that means that a lot of people who were, just putting their money into savings accounts, or maybe even taking out some government bonds, were making 0 or 0.1% return on their savings. And if you're getting taxed at a 1.2% rate, so a 30% tax on a 4% deemed income tax rate, then your effective tax rate on a 0.1% return is 1,200%. And if this happens year after year, you can see this happens for 7-8 years straight here, people start thinking, wait, based on a legal fiction, which is what this is called in good tax jargon, based on a legal fiction that was meant to make things easier, I'm getting overtaxed, because not only do I need to hand back in all the return I've made, I also need to not only, I'm not just paying the fruits, but I also need to chip into the tree. And that's when the first court cases started arising. And this is where, well, the Dutch Supreme Court said, next question is whether taxpayers at a systemic level were confronted with an excessively heavy burden. This is the case if the nominal return that could on average be achieved without significant risk, so this means not equity investments, but debt investments like bonds, that risk is significantly lower than 1.2%. But the Supreme Court was still patient here in 2014, 15, 16, and said this means that the legislator has to fix it. And this was the first warning shot. And that's when we got into this very funky intermediate phase where we looked at first sorry, this was great. First, we said, okay, so we need to make sure that the 4% deemed income rate, it approaches the actual rates a lot more accurately. And so what we started doing then was we look at debts, and we look at savings, and we look at investments. And that's when we had a so-called double fiction. So first we said there's a deemed return on investments and a deemed return on savings. This is linked to mortgage interest rates or government bond rates and index rates. And then we also have a deemed allocation of your money between saving and investment. And that was because a famous French economist, Piketty, came to the Dutch House and said, people with larger wealth tend to invest more, and people with less wealth tend to save more. So we came into this category where we had a so-called double fiction. We had a deemed return on savings and investments and a deemed allocation of, of your assets to savings and investments. This actually led to the Supreme Court saying you're making it worse for people with significant savings because you're actually increasing their deemed rate of return based on not only one, but two fictions. So you need to change that. That's when we got into this intermediate variety where we said, okay, so we stay with the deemed return on savings, investments, and also a deemed interest rate on debt, but we stick to the true allocation of your assets. And so, yeah, I put Stewie up top there. People started to get a little messy with this because, nobody could really calculate what your box 3 charge would be anymore. And we were still straying further from the truth. And that's when this got back into the picture as well. Since the legislator didn't really step in, the Supreme Court did. So somebody took their 2016 and 17 tax charge to the Supreme Court. They were taxed. They had a 600K savings portfolio. They made 6K in return, and they were taxed for, a lot more, about fourfold. And they took it to the Supreme Court. But just mind you, all of this started with a person who made 6K in returns and was taxed for 20. It was a 600K savings portfolio. So butterfly effect. Took it to the Supreme Court, Dutch Supreme Court in The Hague. And that's when we got our famous, at least in the Netherlands, Christmas ruling. Christmas, December 24th, 2021. That's when the Supreme Court said, we've been warning the legislator for 8 years, and they refused to take action just because I think they're happy with the revenue that Box 3 came up with, even if it meant that many people were being overtaxed. And they said, for a taxpayer who, like the interested parties in the year at issue, is confronted under this deemed return system with an assessment and income from savings and investments that exceeds the actual return achieved, this results in a violation of the rights guaranteed to them by Article 1 of the First Protocol, read in conjunction with Article 14 of the European Convention on Human Rights. And what that means is, since European law supersedes Dutch law, that the Dutch law for these people is, inapplicable. And it means that the Supreme Court issued that these people needed to get refunded. And that is when a budgetary gap comes into existence, and that's when you have the attention of the legislator. This is because the overtaxed were provided with an opening by the Supreme Court to prove their deficit versus the deemed return, and they could claim refund, so they could not be taxed then for a higher return than actual return if it was below the deemed rate. But at the same time, the law was still in place, and so the people who were making a greater return, of course, did not knock on the tax authority's door and say, "Hey, look, I actually made more." They said, "No, it's actually capped at the deemed rate," which, legally speaking, is true. So that means there were refunds there, but where this system used to be somewhat acceptable because you had winners and losers, and sometimes you paid a higher effective rate, sometimes you paid a lower effective rate. What happens here is you effectively never pay a higher rate, because if you make more return, you pay the cap rate and the rest is yours. And if you make less, you prove your deficit and you get a refund. So legislator, knock on in. So that's when Dutch news also gets involved. Here's a Volkskrant article. Reinoud van der Heijden has the question here, and he's right. What's the use in refunding billions to wealthy citizens? And this is exactly, I want you to keep this idea in mind, refunding billions to already wealthy citizens. We had to look at how can we change Box 3 to cover the budget, but also to make it be perceived as a more fair system. And that's when the Secretary of State, Marnix van Rij, stepped in and he said, all right, it's time to start taxing on actual returns in Box 3, because we're 20 years or more than 20 years down the road. Our current state of tech actually would allow us to keep track of real returns, and people conceive it as much fairer, and also we should be able to cover the budget gap with this. Um, and so we had consensus. We're going to start calculating the box 3 return based on actual returns rather than deemed returns. But then the next question is one around timing. If you speak of actual returns, when is a return made? So the first question wasn't difficult to answer. We propose to levy personal income tax in box 3 on the basis of actual returns generated. But as far as timing goes, yeah, we made a surprising choice. We're going for a capital accrual tax rather than a capital gains tax. And this is the basis of the international memery that we are confronted with today, and rightfully so, because a capital accrual tax is a world unique idea. But why did they do it? Just so you know, if you're into the bubble that is the history of box 3, it actually makes a little sense, and that's the worrying thing about it. Look, if you have a capital accrual tax versus a capital gains tax, a benefit is that you do not promote deferral and likewise product. So before 2001, so I've heard at least, we had a capital gains tax already, and that led to the financial sector introducing all sorts of funky products that allowed you to delay and defer capital gains that you made, and turn it into continuation funds or slow drip receivables or whatever. So that's what they call the lock-in effect. If you have to pay the tax, if you sell something, people have tax reasons to hold on to their assets, and they also have tax reasons to create all sorts of artificial products. I kind of think this is a reverse engineered argument, because at the same time, you could say if you pay tax on an accrual basis, you have tax reasons to liquidate assets, or to put pressure on your investment to generate returns rather than reinvest. So it kind of goes both ways, but this is one that was highlighted quite a lot. Another thing here was, if you do accrual tax, you don't need to store information for too long, because it's really only 1 year that's important. Whereas if you have capital gains tax, you may need to ask banks to keep files for over decades. They did see some weaknesses. For instance, if you have a capital accrual tax, you have to do annual reappraisals, which can be a costly exercise, and there can be liquidity risks. But a very important one was the idea that with capital accrual tax, you have immediate revenue stability. Whereas if you introduce a capital gains tax, there is a gap. So this is the decision that was made. A capital accrual tax it will be, rather than a capital gains tax. So what's the system that was proposed or actually accepted? It's a capital accrual tax with a loss carry forward, but not a carry back. So there's a high watermark. And we look at the total asset base, and it's not a per element thing, at least, unless you have an exempt category of assets. So how does this work? In this example, in year 1, some person acquires a portfolio stake. Year 1's a profit year. Year 2 is a profit year. At least the rate goes up. So regardless of whether they receive some sort of a dividend or realize some sort of a sale, their asset value increases. So they're going to pay tax on the increase. In year 3, however, there's a significant loss. They would not pay tax in this year, but also they will not get a refund for their loss. So it's not a mathematical tax where the government also shares for 36% in your capital losses. It's just the ride down is tax-free, and then the ride back up, I call this the high water mark, is free as well. So if you look at year 4 and 5, the portfolio recovers. So there is actually capital accrual, but this is tax-free because there's a loss carry forward, so they can offset against losses incurred. So going back up to your highest point is tax-free. Year 6, there's accrual. So tax paid again. And in year 7, portfolio is stable, no accrual. However, they do sell. So there is a capital gain, but they pay no tax because the tax has already been paid. Is there a time limit on loss carry forward? Good question. I believe not. Yeah, so good one. No, I believe the recovery time is unlimited. But you can expect that if there is a tax benefit, this of course is one of the very tempting buttons to play with creating loss carry forward limitations in box 3. Yeah. Yes, Martijn, loss carry forward is across all of your investments together. It's a manche, it's a bucket thing. So everything is pooled. So it's on a subject basis, not an object basis. But as you can see here, yeah, so Oscar, good question. How are illiquid assets in startups priced? Fair market value. So this would be reference transaction, priced round, and otherwise discounted cash flow valuation is the way to go. So good. So let's get to the startup angle here, because if we look at this seems fair enough, right? Because for a lot of portfolio assets, this might not be a problem. So let's say you have current or trading elements. What I mean by that is stuff you could sell, or non-current or trading things. So things you may not want to sell or be able to sell. Dutch BVs, notably, often have a lockup framework. So you cannot freely sell shares in a Dutch BV if the statutes do not allow you to. And then you have, roughly speaking, growth and profit shares. I think this is obvious for anyone building a business. If you have cash at hand, you can choose to do two things. You can make a distribution to the shareholders. So take the excess cash off the top and it's de-risked. Or you can reinvest in growth, which means there's no capital movement for the owners, but their asset value does increase. And so you can imagine that if you have a growth share, but it is trading, which could be, for instance, a high growth listed company, say SpaceX over the last few years, or NVIDIA, yes, you do have a problem, but it can be solved because you could choose to sell part of your assets, which of course in its own stands between yourself and the compounding interest idea. So it's not good for generating wealth as a Dutch investor, but it is a problem that can be addressed. And if you have profit shares, whether you can trade them or not, you would not really have liquidity constraints because, yeah, there is a capital movement. But the largest problem is where you have a growth share that you cannot dispose of. That's where liquidity constraints start. So then if we look at the classic list of box 3 assets, there's a few elements at risk. I would say checking and saving accounts, doesn't matter if it's capital accrual or capital gains tax, because most savings accounts you get an annual interest paid, and that also is your actual accrual of the base, and at the same time your capital gain. So, and that's 80% of box 3 assets. So over there it doesn't really matter. And for stock portfolios, listed stock portfolios, less of a problem because you can cover for tax, exercise for tax. It becomes more problematic if you look at real estate, especially second homes, or maybe even investment real estate, because maybe the assessed property value goes up and the increase is more than you've made in rental income. So then again, you'll be paying a cash tax that's greater than your actual return, or let's say greater than your cash return. For bonds, the issue shouldn't really be there. For art collections, the same idea is at stake because there's not a cash movement, but it becomes really problematic if you have a stake in a high growth company. So for startup and VC investment, including employee incentives, because if you own stock in the company, it's less than 5%. You as an incentivized employee would be in box 3 as well. And this is where it becomes really squeezing. And that's kind of at odds with the Dutch idea of becoming a top 5 startup nation, because we have, well, limited natural resources, high wages, and we want to be a top 5 startup country just because innovation is where we need to find it if we want to play any role of influence on the world stage and also have lasting future perspectives. So one may see that for startups and venture capital, this is especially problematic, which is also where the memes come from. Jeroen, I will get to your question later because this will be addressed in a later slide. Luckily, people do shepherd the Dutch innovation atmosphere. Notably, in this situation, it was Tech Leap, the platform for the Dutch tech sector, who engaged the services of a luminary tax company called Archipel, and together they came up with a report that kind of pitched why this is especially a bad idea, capital accrual tax for the innovative space. Very briefly put, we said, look, you want to be a top five ranking global startup place, but you're ranking 14th right now. And which are the bottlenecks? Access to capital and access to talent. So, we've invested in a very good infrastructure here, good education, and we want to make sure that we can capitalize on that. And if we want to do so, we need to make sure there's better access to funding, better access to talent. And what that involves, if you look at who can be on a cap table of a company like this, it involves box three actually, because this may cover angel investors, early stage investors, but also incentivized staff. So if you want to reduce burn rate and give people less fixed pay, which under Dutch labor law is especially important, and you want to have them share in the upside, they would become box three shareholders in the company, as would many angels. Of course, people with very large portfolios, they may be able to structure such that they end up in box two. But let's just take the base case. If we want a efficient tax system, you don't want people to have to plan inorganically around a regime. And mind you, for my own revenue, it would be fine to do all this sort of work, but maybe for the broader ecosystem, it's not a good idea. And so we said, look, this is what happens with startup investing. It's already risky, so you don't want to discourage it because there's a bias fallacy in the human mind, especially in the Dutch mind, by the way, where people prefer 100% guaranteed 5% return, if there is such a thing, over a 90% chance on a 6% return. Everyone who understands game theory knows the latter is the more rational choice, but the investor would usually pick the 100% guaranteed return of 5%. And that means we already have a suboptimal investment level in innovation because its returns are always uncertain. And also there's a power law in this. You need to make a lot of investments if you want to make this work, which means people make many smaller tickets rather than single big ones, which also increases the risk that they would fall under the scope of box three rather than two. So we said, is it really as neutral as you think? We said, a capital gains tax is kind of always neutral because there's never a mismatch with cash flow. And if you look at capital accrual tax, anytime there isn't a cash movement, there is a mismatch. And we said, here's an example of how this can end up. Just imagine you're the unlucky owner of a high-performing share, and you're maybe first or second career phase. You just graduated from technical uni, and you started working at a startup that suddenly, its value increases sixfold in a single year. And it just happens to be the year after you purchased your stock with, well, what little wealth you have. You may actually have to pay up, X-fold of your net pay just to be able to afford owning the stock. And it just becomes, very unenticing for talent to choose the startup route. So you get outcompeted by blue chips, but also for the investors, it becomes a scary affair. And the question is, are scenarios like this, are they realistic? We said yes, because these are some, poster child Dutch startups. And if you look at their maximum year-on-year value increase, it can go up to 263% in a year. So if you're paying 36% of a 263 year-over-year value increase, you're almost paying back the whole investment amount in tax just for owning the shares. So we said, bad idea, notably so because, Jeroen, we would be the only ones to do it. If we look at the nations we compete with on the startup rankings, these all have a capital gains tax, except Singapore. It has no capital gains tax, but also no wealth tax. So it's a pretty good system. But we would be the only one going for a capital accrual tax. And we already are the only one with something different. So you can imagine this gives a home market penalty. If you are a French investor in a Dutch startup, you do not face the capital accrual tax. If you are a startup staff member and you move to the Netherlands, you face it. If you move abroad, you do not. So it gives an incentive to find different investors and to not move to the Netherlands. So we said, what's our recommendation for startup companies? go for a capital gains tax if you're serious about making the Dutch startup space more productive and that top 5 spot that we eyeball. Well, guess what? Guess what? Uh, Big success, because it was in fact already included in the legislation that's been adopted, and this is kind of under highlighted. So this is actually from the Memory of Understanding. It says, as an exception to the general rule, immovable property, that's a different lobby group, by the way, and shares or profit participating rights in startup companies will be subject to a capital gains tax deferral mechanism. What is the definition of a startup company then? So you can see this in Article 5.17. The already adopted Act states that a startup company is a company that was incorporated no more than 5 years ago, does not carry a business that started more than 5 years ago. What does this mean? You can't start a new shell, do an asset deal with a pre-existing business, and then qualify for startup classification. You cannot have a turnover exceeding 30 million. You can't be listed, and you can't be a related party to a, well, non-startup entity, basically. So this is the current setup. And you may see this is kind of limited. I'm not sure what you guys think of this definition, but yeah, it's I don't know, it's a bit limited, right? And also, just because there's this temporal effect, there's a 5-year maximum. It means you kind of give this benefit to incremental innovation, but for deep tech or med tech R&D, this is not enough. However, this has been taken note of. So there is a different dossier that's at play, and there is a startup definition also going on because we implemented new ESOP rules. So to make sure that it's easier for companies to attract staff using a stock option plan, um, there is a startup ESOP rule. And for that startup definition, we're looking at something broader. And it's actually listed here on the left. Under the new definition, a company qualifies as a startup if the following 4 cumulative conditions are met. 1, the company is innovative and its business activities are scalable. 2, the company can demonstrate through a growth plan the steps required to realize the scalability. 3, the company is operated as a private limited company or comparable. The company is not in suspension of payments or insolvency. So that's the distressed companies test. You submit this to the Netherlands Enterprise Agency, which is also in charge of the WBSO rulings, etc. Gives you a positive assessment, and it gets issued for 8 years at first, and you can keep extending it for 5-year increments. Yeah, and so I see some questions in chat. How are we going to demonstrate that a company is innovative or scalable? Yeah, good question. That's actually the framework that's being designed right now. So this would be underpinned by some sort of a decree. And I agree that it is not a super clear law, right? There's legal uncertainty there. I will say, however, that in this subjective and broad definition also lies the opening for many companies to enter this. And it does alleviate the limitations of the, well, very limited but very clear definition we have going on. What happened is the Minister of Finance has said, we're going to combine the dossiers because whoever thinks that, organically speaking, tax law would have aligning startup definitions for box 3 and for the ESOP rule has not been in touch with many tax laws. That would be way too simple. But luckily, we are combining these two definitions and making it a single one. So the intention here is that box 3 startup definition will align and will be this more loose, but yeah, still very open for debate definition. Still lots of work to be done, setups to improve. So there's 2 things you can do. You can make noise like Frederik is doing right here. He's saying, it doesn't matter if you're in a startup or scale up or not. The real thing here is one of the ways we defended the capital accrual tax versus the capital gains tax is that it's just a timing issue. And at the end of the road, you're paying the same amount of tax. This would be the case if you invest only with part of your assets and you have sufficient cash at hand to pay the annual charge. Then it will end up in the same place. But if you're investing with more, like maybe you should do, or if you have a unexpected success, so it eats up more of your assets, you may have to dispose of part of your assets on an annual basis. And if you get to that situation, because of the lack of compounding interest, you actually end up with less tax, but also less assets, less wealth for the taxpayer involved. So it's actually destructive both for revenue and for asset base in society. So it's actually capital destructive. So Frederick, for instance, is one of the people making noise to get to better policy. At the same time, we can do defensive measures, right? So you can plan around box 3 if you don't trust the dossier. Many things you can do. So if you look at this setup, there's a startup company. You see this one unlucky guy who I color coded red, who's a Dutch resident direct share owner of 3% of a startup company. He is in the box 3 regime and may or may not be able to use the deferral mechanism, the exemption. If you look at the British shareholder, no problem. And if you look at the other two guys who also own 3%, but combined their stake in, for instance, an intermediate aggregator like a cooperative or a holding company and own the shares in that or profit rights in that through a personal holding entity, they're actually in box 2 and they'll be paying capital gains tax and even at a lower rate. So I'm not sure this is what the legislator should want, because it seems like a lot of people would be considering defensive measures like this, and it's going to lead to an influx of incorporated intermediate empty holding companies that all need to make annual accounts, deposit them with the Chamber of Commerce, get audited by the tax authorities. I don't know if this is the way we want to go. Like I said, for me, it's fine. This is my profession, so you can call me for this any time of day. I just think it's unproductive. But know that it is a work in progress, because the government that proposed this legislation is a different one than the one that's being installed right now, because we just had elections. So what's the update on the dossiers? The startup definition is still a work in progress, and it is being combined. And so it's being combined in such a way that the broader one, the one that involves the Netherlands Enterprise Agency, will be transported to the box 3 dossier rather than the other way around. And also a motion, I'm never sure what the English translation of that is, but a legislative initiative in the House was launched and accepted that said, hey, how about we just go for a capital gains tax altogether, which aligns perfectly with what TechLeap and ourselves already said in 2023. If you look at the asset composition of box 3 as a whole, most of it already doesn't matter if you're in a capital accrual or capital gains tax. But there's one, even with the startup exception, there's still a very large portion of the market that may be in trouble, and that's the Dutch SMEs, because they're kind of caught between a rock and a hard place now. So it is a work in progress. The government has already announced that this act would go into effect on January 1st, 2028. So they're still close to 2 years to make alterations. Really, I consider this a bit of a backstop to the budgetary leak. And it also gives the legislator a sense of urgency to get to work. So to get to work with, for instance, a revision of the system to make it a capital gains tax altogether, and definitely with the startup definition, getting that in place, and also making sure everybody knows what's up. So to recap, we started with box 3. It kind of made sense then when government bonds had a 6% return, but as quantitative easing came, the winners and the losers became more apparent, and the legislator or the Supreme Court fired some warning shots. And when the legislator didn't respond, they ruled the system incompatible with EU law, where people were being overtaxed systematically based on a fiction. That's when we had a box of Pandora intermediate phase with all sorts of funky alternatives, which people were very disgruntled about. That's when 23, we had government consensus. It's time. We got to start taxing real returns, not deemed returns like the rest of the grown-up countries around us. However, in a lapse of judgment, they decided 2025, it will be a capital accrual tax. Good thing people highlighted the importance and the bottlenecks for startups. Coalition falls, new elections. What happened? We have a motion filed and adopted to go to a capital gains tax altogether. In the already accepted backstop legislation, there is a startup and venture capital exemption. This one is intended to be improved. And, in the background, there's the accepted ambition to go to capital gains altogether. So there are parachutes. I do agree this is a PR nightmare. Am I proud of what the decisions made? No, I am not. I'm looking at some questions in chat. Um, in box three, Alum Geibel says, in box three, does the debt lower the number on which the capital accrual tax will apply? Um, no, it only it lowers the return. So the debt doesn't. That's the previous system where you looked at net asset value. Over here, a debt usually would have a capital loss because you're paying interest, and you can offset that against your capital gains, or at least capital accrual, I should say. Martijn says, seems like a broadened definition is a good step. I'm still puzzled how Dutch government can already publish a new tax regulation without key definitions included. Uh, yeah, I kind of agree. At least it's good to see. I think it also has to do with a new government being installed in the meantime, so they have a little bit of a different view on this. And yeah, I agree. This is very puzzling. And that's also why I think it's largely misunderstood and why we're being made fun of in memes and on Elon Musk's X account, etc. And yeah, Oscar says limited exemptions from a bad tax that's rearranging deck chairs on the Titanic. Nice one. Accrual will create the perfect brain drain if it stays in any format. 36% is already an extremely high capital gains rate. That's true for any country. My guess is top quartile to decile. Yeah, I agree, guys. And Devesh asks, at what point do startups stop getting the exemption, and what happens when startups no longer get classified as a startup but are still illiquid? Yeah. So what happens then if they stop getting the exemption currently? That's when you go past the cash register. So you can stop being it's going to be a deemed disposal of the shares, so to say. So if after 5 years you no longer qualify for startup label, you go back to the regular systematics and you are taxed for the intermediate capital accrual. So yeah, there are always cliff effects where you have a definition that has a maximum turnover or maximum age in it, because when you reach it, the exemption stops and you fall back into the regular system, and it's a cash register event. Ties asks, if you move your shares in a BV, it would fall into box two. That's true. However, keep in mind, if your BV does not own at least 5% of the profit rights, or in another way arranges for a participation exemption setup, this is not a super good idea, because if you have 3% of the shares in a holding BV, let's say the startup company makes 100 in profit, pays corporate income tax at 25, so you get to distribute 75 to the holding company. If the stake does not qualify for the participation exemption, which roughly speaking means it needs to own 5%, it's going to pay 25% tax on the received 75 again, which means you get to keep roughly, what is this, 55, which after you pay it out to yourself is a box two element taxed at 25 to 31%. So you're racking up roughly 62% combined tax. At least you're done with the mismatch between the gains and the cash element, but the price you pay is a 62% cumulated tax rate. So I don't think that's the way to go. Let me see if we have additional questions. If you want it, there are ways to set this up effectively, but it would require pooling of assets or incorporating legal entities like cooperatives, whatever. That's work I advise not to do by yourself. Get a little bit of a legal team involved. And I say this not just because it's stuff I do, but it's because this has a significant risk of just missing the target. Um, yeah. So, and Jeroen, you ask more reflective question: how does this rank against other nations? Poorly currently, I would say, and I think we're all in agreement here. Thomas Smith says plan is to publish a concept of the legislation with a new definition of startups coming March on the internet for consultation. Please keep that in mind if this is a dossier that interests you and you think getting better policy in place is a better way to go forward than to take defensive measures that can be a little artificial and costly. Then let your voice be heard, because I think if we have to take anything positive from this, it is the fact that the Dutch legislator has in fact listened to a effective startup lobby. So it's good to know that the Dutch legislator is listening to startup companies. Yeah, Martijn says The Dutch government is definitely not scalable themselves with the 9 months they are taking to publish a solid startup definition. Yeah, sure, it's not. It's a government. I would hope they're not scalable because they've scaled rapidly enough the past few years. And not to say they're not doing valuable work, but yeah, I think they're at size. Um, Absent any further questions. Oh wait, Jordi, with the expected capital gain tax coming after this, does that make the flight to box two less interesting, or is it not a good idea at all? Yes, it would make it less interesting. The only thing there, of course, is that box three is still being levied at 36%, whereas the box two top rate is 20 or 31%. So like I said earlier, if you look at the current state of the Dutch personal income tax code, which, in my perception, for at least, well, maybe 75 to 80%, is anti abuse legislation, which also pertains largely to arbitrage between the boxes. I think using different rates is a bad idea altogether. One of the suggested approaches is to just abolish box three altogether and toss everything into box two. I actually don't think that's a bad idea. The only thing is, there's an earn in effect to a new wealth tax. There's a budgetary gap we have to close. And you can only imagine the public outrage if that means that in the meantime, we have to raise taxes on groceries, gasoline, or income, because then the regular Joe is paying for mercy rules for wealthy investors. So it's kind of a catch 22. So the best moment to introduce a capital gains tax was always 5 years ago. But I guess the next best moment is today. And that leaves questions about how do we find the budget. Uh, Thanks, guys. Thanks for joining. I will share the slides if you like them, use them, share some source documents, upload a replay. And I thank you all for attending. Cheerio and have a good Thursday.